Good afternoon, everybody. And thank you for attending the latest installment of the Stowe & Deegan webinar series. I'm Marty Croyle. I'll be the host today. I'm a partner at Stowe & Deegan, and in a few moments, I'm going to be introducing my colleague, John Reardon, who is going to speak about our topic today of valuation for IRS purposes. Next slide, please. There's John. There's Marty. Next slide, please. So a couple of housekeeping matters before we turn this over to John. We welcome any and all questions. There's a Q&A box at the bottom, and type in any question that you have. And if we can't get to the answer to this during today's time, we will respond to you after the webinar is over in the next couple of days. Secondly, the program today is being recorded, so you don't have to take all sorts of notes if you don't want to. And if you'd like to get a copy, please email us. Stowe & Deegan does have a YouTube channel, and this program will be loaded onto the YouTube channel in the next couple of days. And finally, there'll be a webinar. There'll be a short survey after the webinar. Please take a couple of moments and respond. We'd like to know how we're doing, not only today, but for future topics you'd like to see us do. So, next slide. So today is October 29th, 2024, and as you're going to find out in a few minutes, a lot of the things that John's going to talk about today have been in place for years and years and years and years. But things do change, and we do have an election next week. So if you run into these issues and you go back to this webinar, remember these are the best facts we have as of October 29th, 2024. So please seek advice by contacting either John when you need him or your main contact at Stowe & Deegan. And without further ado, I'm going to turn it over to my colleague, John Reardon, and he'll talk about valuations with the IRS. Take it away, John.
Thank you, Marty. Welcome, everyone. Thank you for spending some time with us this afternoon. I just want to reiterate that today's topic is going to be valuations for the IRS, which have certain idiosyncrasies and nuances to them, which make them different from valuations for other purposes. This is not a topic of valuation, say, for selling a business outright to a third party, or valuations that may be used in divorce proceedings or shareholder disputes. Those have unique idiosyncrasies and requirements, and those are different topics. So on today's agenda, we're going to be talking about the reasons you might need to do a business valuation for the IRS, IRS rules and regulations, significant case law, the importance of discounts, and then we'll follow up with a brief question and answer period at the end. Next slide. Okay, why do a valuation for the IRS? You could have the death of the business owner, gifting of a business or a business interest, abandonment or casualty loss, charitable donations, non-cash distributions, employee stock options, or C to S corporation conversions. IRS rules regulations and cases. IRS ruling 59-60 is the I.R.S. It is the 60th ruling of year 1959. It is probably the most significant revenue ruling relating to business valuation as far as the IRS is concerned that has come out. Revenue ruling 77-287 regarding restricted securities. Revenue ruling 93-12 regarding the family members. Mandelbaum v. Commissioner. Gross v. Commissioner. The estate of Jones, and Connolly versus the United States. Next slide. From Revenue Ruling 59-60, appraisal requirements for the IRS. The appraiser holds himself or herself out to the public as an appraiser and performs appraisals on a regular basis. The appraiser is qualified to make appraisals of the type of property being valued. The appraiser is not a donor or donee of the property, a family member of the donor or donee, employed by the donor, donee, or a member of the family of either. The valuation must be based on the facts available at the required date of the appraisal, what was known or knowable. And this is significant in that we do not make adjustments for things that happen after the fact. Next slide. The appraisal report. The appraisal report, again from 5960, must include the date of the transfer, the date of the appraisal, the purpose of the appraisal, a description of the property, description of the appraisal process employed, assumptions, hypothetical conditions, and any limiting conditions and restrictions. All financial data used sufficiently detailed so that another person can replicate and arrive at the same value. Reasoning to support opinions and conclusions, and the rationale for valuation methods used. Next slide. Standard of value, the fair market value, again from Revenue Ruling 6960. According to the IRS, the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the relevant facts. The standard assumes a hypothetical buyer and seller are assumed to be able as well as willing to trade and to be well informed about the property and concerning the market for such property. And I think the key takeaway from this slide is that it is a hypothetical buyer, not a specific buyer. Next slide. Also from 5960, there are 8 factors to consider for valuation. The nature and history of the business, the economic and industry outlook, book value of the stock and the financial condition of the business, earnings capacity of the company, dividend paying capacity of the company, any goodwill or other intangible value, past sales of company stock and the size of the block of stock to be valued, as well as market price of stocks of guideline publicly traded companies. Next slide. Other factors to consider. Weighting to be accorded to various factors. A holding company versus an operating company. An operating company is typically, your company that is out there making product and selling versus a holding company, which pretty much just handles assets. So the weighting of which approaches you use should be accorded based upon the type of company that's being valued. Use of capitalization or discount rates. The capitalization or discount rate is the mechanism by which we equate future cash streams to a value today. They can vary widely from industry to industry and period to period. There is no standard formula or approach for determining discount rates. They should be based on the nature of the business, the risks involved, stability or irregularity of the earnings. And when it comes to valuations, there is no purpose to just averaging approaches. They can be averaged if it makes sense, but there is no value to just doing it just for the purpose of averaging. Next slide. There are 4 levels of value when it comes to doing valuations. At the highest level of value, we have investment or synergistic value. This is the value that somebody who has a specific purpose for buying a business. It could be somebody in an adjacent industry. It could be a competitor. It could be someone looking to forwards or backwardly integrate. This is somebody who has a particular purpose of buying the business and will be able to create additional wealth by integrating with their own operations or based on their own belief, their better management skills. Control marketable, the next level down. Control marketable is the level of value for somebody who is able to acquire controlling interest in a company and a company that is able to, the interest is able to be converted to cash relatively quickly. On the next level down is minority marketable. This is less than control. This is a shareholder who does not have control, but is able to convert the balance easily to cash. This would be your typical shareholder in Apple or IBM or anything that's publicly traded, for which you do not have the ability to affect the company's operations, but you can still convert to cash in a relatively short time. And at the lowest level of value is minority non-marketable. This is the situation in which you do not have control in the company, and it would take a while to convert it to cash. Next slide. Advantages of being in control. You can set company policy, appoint management, buy and sell businesses, select vendors and suppliers, sell shares, set dividend policy, set compensation levels, or block any of the above. So generally, having control is worth more than not having control based on these attributes. Next slide. So therefore, not having control results in what we call a controlled discount. Controlled discounts can be quantified based on observed premiums from acquisitions in which the acquirer was acquiring 100% of the subject entity. Controlled discount can be quantified as 1 over 1 minus 1 over 1 plus the control premium. There are various studies out there that take a look at the value of a stock, 60 months, 60 days, 90 days, 120 days prior to acquisition, and track the increase in the premium after the acquisition is announced and after deal consummation. The ranges of control premiums range from 20% to over 50%. Control discounts, I'm sorry, the inverse of the premium. Next slide. Revenue Ruling 93-12 transfers among family. Previously, the IRS had held that there was no discount for lack of control among family members. If you had a closely knit family where the brother owned 20%, the sister owned 20%, and the parents owned the rest, or they generally held that the family members acted in concert and there was no discount for lack of control allowed. This was often challenged by taxpayers successfully. In 1993, the IRS finally relented and codified in 93-12, corporations with a single class of stock, the shares of other members will not be aggregated with the transferred shares to determine whether the transferred shares should be valued as part of a controlling interest, which is a long way of saying that they finally recognize that among family members, there is a lack of control, or can be a lack of control discount. Next slide. Marketability discount. The inability to convert interest to cash, all else being equal, should be worth less. If you can just go to your stockbroker and say, I want to just dump whatever shares I have and get your money back in 2 or 3 days, that's going to be worth more to somebody than somebody who has to wait 6, 9 months or even a year or more to get their value. They're generally quantified via restricted stock studies. There are many public companies out there that have multiple classes of shares, some of which are restricted in regard to trading and some of which are not. And by looking at the premium or the discount that the restricted shares trade relative to the unrestricted shares, we can estimate that the median value of these restricted stock studies from 9 to 45%. Revenue ruling. I think we went back one slide. We want to go forward 2 more. There we go. Revenue ruling 77-287, restricted securities. This is the revenue ruling which the IRS officially codified and recognized the lack of marketability discount. Securities cannot be lived from securities that cannot be lawfully distributed to the public. The longer the buyer must wait, the greater the discount. Additionally, if the buyer has to bear the expense of any registration, the greater the discount. Mandelbaum v. Commissioner. This is a significant case because the only issue before the court was the discount for lack of marketability. And in this case, the judge, Judge Laro, who is a famous judge from the Delaware Court of Chancery, has made many famous decisions on business valuation. Judge Laro came up with 9 factors to consider in adjusting from these benchmark studies. Judge Laro, in his decision, emphasized that one must consider the discount willing sellers would accept in addition to the discounts that a hypothetical buyer would demand. Next slide. These Mandelbaum factors are financial statement analysis, dividend policy, the nature of the company, company's management, control and transferred shares, restrictions on transferability, the holding period, the company's redemption period, and cost associated with public offering. Next slide. Pass-through entities. Now, this is probably one of the most contentious issues still existing within valuation work. S corps, partnerships, and LLCs pay no tax at the entity level. The income is passed through and the tax is assessed at the shareholder level. So all other things being equal, without paying tax at the entity level, a higher cash flow should equal higher value. However, the IRS does not like this policy because it winds up in lower taxes. The IRS policy is for pass-through entities such as S corps, partnerships, LLCs, is to not tax effect. And when I say tax effect, what I'm saying is to decrease the income stream, the future benefit stream for hypothetical taxes that would be paid at the entity level. Certainly, that would make something less valuable. Next slide. Gross versus the commissioner. This was a significant case because this is the first case that really put this concept to the test. The court sided with the IRS and stated that a reduction for taxes on a hypothetical transfer was not appropriate. However, this violates the hypothetical buyer and seller premise of 5960. If you own an S corp, you're an S corp shareholder, or you own an S corp or an LLC, and you're looking to sell, in order for you to maintain that pass-through status and not run afoul of it, you can only sell to somebody who is eligible to maintain that status, and that would be another S corp or somebody else who could maintain the LLC or limited partnership organization. That would exclude all C corps as potential buyers, which would violate the hypothetical potential buyer and seller premise of 5960 and exclude a huge population of potential buyers. So this position of the IRS has been challenged several times successfully. There's a significant case called Kress versus US, Jones versus Commissioner, and Cecil versus Commissioner, all in which the petitioners, the taxpayers, tax affected the earnings and petitioned the IRS to say that they were correct. And it was interesting in all of these cases when the IRS hired their own valuation expert to do their independent valuation for the IRS, the valuation experts for both parties wound up tax affecting the stream. So the disagreement in whether or not to tax affect the streams appears to be a disagreement among lawyers and not among valuation professionals. Next slide. Connolly versus the United States. This is a relatively recently decided case that went all the way up to the Supreme Court. And we bring it up here because it's a typical, it's a very common way for companies or shareholders to fund repurchases of shares upon the death of an owner. In Connolly versus the United States, the company purchased life insurance on 2 owners to fund repurchase of shares. 2 brothers owned a company each, and the company bought life insurance policies on each of their lives so that when one of them passed away, the proceeds would be there to buy back the shares from the decedent shareholder. One of the shareholders did die, and the company collected the benefits. The company included the gross proceeds from the insurance policy in its assets when doing its valuation, but it also included a liability to the decedent's widow for the repurchase of the shares. The IRS disallowed the liability, the repurchase obligation, but included in the assets the proceeds from the collection of the insurance. And the US Supreme Court sided with the IRS, and I think that their logic was considerably flawed, and it might have to do with the fact that they're not particularly astute business persons, but it is the law of the land, Rob, and it has been cited by the US Supreme Court. So I don't know exactly if there's any challenge to this one. So we bring this up for a particular reason because the use of life insurance as a means to funding share repurchases and closely held business is very common. I think that anybody who is using this or contemplating using this needs to be sure that the insurance is properly titled. It would definitely behoove anybody who is using the strategy to consider having the purchase, if they are owned by the company, retitled outside of the company somehow, either through the creation of an insurance trust or through cross insurance agreements with both partners or multiple partners. Next slide. So why does all of this matter? Most of this matters in relation to the unified gift and estate tax exemption. The unified gift and estate tax exemption is currently 13.6 million. It was, I believe, originally back in 2017, 5.5, and then in the Tax and Job Cuts Act of 2017, they initiated a bonus exemption, effectively doubling it from 5.5 to 11, and then it's been indexed for inflation, and it's currently at 13.6 per person, and it's 27.2 for a married couple. It is set to revert back to the old index for inflation original exemption, which would be around $7 million after 2025. Next slide. So let's go through a numerical example to see how these factors affect taxes. We have a specialty medical manufacturer based in Massachusetts. It's an S Corp. It's been in existence since the mid 80s. Sales of around 30 million, growing at 33%. Gross profit around 65%. Net income of 9.5 million. Cash flow of 10.4 million. Okay, next slide. Now, I know there's a lot of numbers on this slide, so I don't think we need to pay too much on them, but using the income approach and growing out the sales from the current year, 5 years, and affecting a terminal value and discounting it back at a 20% discount rate, cost of capital, that equates to about $38.25 million in value. And this is without tax affecting, without reducing the income stream for a hypothetical tax that will be paid by anybody other than an S Corp or a LLC. And this would be the IRS's position. Next slide. Now, anybody in the valuation world will tell you that you really should tax affect the earnings. So if we look at that same income stream again, and then we layer in a hypothetical 29% tax, corporate tax, 21% at the federal plus an 8% state tax, that reduces the value from the 38.25 to 28.6 million. That's nearly a $10 million decrease in value, which, remember, we're talking about valuations for the IRS. So a decrease in value is not necessarily a bad thing. We're not talking about what it would be to sell to a third party. We're talking about what you're going to have to pay taxes on. Next slide. So if you're planning to do some estate planning and you decide you want to give 20% to each of your 3 children, 20% of the reduced 28.6 million would be $5.7 million per child. As each of them only owns 20%, none of them has control. So they would be subject to a control discount. just, presuming a 25% control discount, because it makes the math a little easier to follow. 5.72 million times 75% would result in a $4.3 million value, a reduction of $1.4 million in value, which again is not necessarily a bad thing. Next slide. As this is a closely held corporation, it's a non-public corporation, there's no ready market for the shares. They would also be subject, or could be subject, to a discount for lack of liquidity. Again, using 25%, just it seems to make the math work out kind of easy. 4.3 million after factoring in the control discount times 75% would equal a $3.2 million on a lack of control, lack of marketability basis. So that's a total decrease of 1.5 million from the 5.7 million increase value just based upon the discounted cash flows minus 3.2 resultant value. That's a decrease of $1.5 million in value. $1.5 million times 3 children is a $4.5 million reduction in the lifetime exemption. Remember, that's the amount you don't have to pay taxes on. So $4.5 million times 45% would be a $2 million tax savings. If you can save that much in the exemption by the application of discounts, there's that much tax avoidance. Next slide. So I think there are 3 top takeaways for today's session. It's the importance of the importance of discounts in valuations, particularly valuations for the IRS. Be aware of tax affecting, and I wish I could tell you there was a right answer here, but there's not. You just need to be aware of the potential impact. If you have a valuation done, if your valuation professional tax affects the earnings, which is not necessarily wrong, you need to be cognizant of the fact that the IRS will or possibly could challenge that. And if you are using insurance policies in order to fund redemptions of shareholders after death, it's important to take a look at those policies and make sure that they are not held inside the corporation, but through some other vehicle. And that's our presentation for today. If you have any questions, please enter them in the chat and we'll get to them. And I'll turn it back to you, Marty. Marty, I think you're on mute.
Sorry, I was on mute. Thanks, John, for your presentation. There are some questions here which I'll pass on to you. Can you hear me, John?
I can.
Okay. First one, I understand that the appraiser determines the percentage discounts you discussed today. Has the IRS set any maximum percentages for control and marketability discounts?
There is no set codified maximum or even prescribed amount. You just have to be aware, I guess, that the higher they go, the more likely they are to be challenged. I would say something in the 20 to 25% range for each is probably acceptable. But there could be situations if you have a very restrictive shareholder agreement that says the shares can only be sold back to existing shareholders and only after a certain amount of time. There could be situations in which a more significant lack of marketability discount, or even a more aggressive lack of controlled discount could be applied. It depends upon the specific facts and circumstances of the case.
Okay, well, if I flip that coin over, I think I have an echo here, huh?
Marty, you're breaking up. We can't hear you.
Oh, boy. If I flip that coin over, can you hear me now?
Still can't hear you, Marty.
Oh, boy. I may be having technical difficulties. I'm sorry. Can you hear me, John?
You're breaking up quite a bit. Maybe it's me.
Okay. Well, I'm hearing it's good now from somebody else, so let me try this. So if I flip the coin over, is there a percentage that I can stay under and I'll feel safe from the IRS?
Um, I would say if you're under 30, you're probably okay. But, like I say, it doesn't necessarily mean that you can't go above 30.
And if I put my company's valuation out to different appraisers, am I going to get different control and marketability discounts,
You
or will it
should.
all come in at the same place?
No, you could definitely do it because it's going to be subject to the judgment of the appraiser, and it's going to be, like I say, there is no prescribed or codified limit, and it's based upon the facts and circumstances of the case, and it's very judgmental, subjective, and it is going to be up to the individual appraiser.
Well, given that, which makes sense, how would you go about picking an appraiser? Is there a recommended list someplace? Somebody knows my industry better than somebody else?
Well, you can hire Stowe and Degon, I can tell you that.
Okay.
Is there a list? I'm not aware of any list. There are plenty of appraisers out there, but
And
certainly,
presumably they need to be certified.
well, yeah, there are certain valuation credentials. There's the certified valuation analyst from the National Association of Certified Agents, and there's the ABV, accredited business valuation from the AICPA. I have both of those designations. Certainly, if you're looking to do evaluation, we'd love to talk to you.
Super, super. Next question. My company owns life insurance on my life and my brother's life. You mentioned retitling these policies. Can you go through that again? I mean, the company owns them. I I heard you say the company shouldn't own them because it could become an issue with the IRS. So what should we consider doing?
Well, I don't know exactly what the mechanics of it would be involved, but I think you need to talk to whoever you bought them from, your insurance professional, and see what can be done about having the policies, not necessarily cashed in, but just transferred and retitled in somebody else's name, either individually in the names of the two shareholders, and then you would probably need to establish some sort of agreement between them so that they would both be legally bound to use the proceeds to redeem the other shares. You wouldn't want to just have a situation where you changed the policy so that the other shareholder benefits and doesn't have to legally buy back your interest, because Lord knows there's never been a disagreement among siblings in a business. You may also, if there's multiple shareholders involved, in the case of like maybe a professional services firm or something like that, you may want to look into setting up an insurance trust, in which case the trust outside of the business would hold all the insurance policies and could use that as a vehicle to fund shareholder repurchases.
So just so I'm clear, and the attendees are clear, if the company owns the policies now, I could consider me being the owner of my brother's policy and vice versa. And when my brother passes away, I'm bound to pay his heirs directly and leave it out of going through the company. That's
That's
what
one
you're
approach,
saying,
and
right?
I'd say, yeah, that would be preferable to leaving it inside the company. I guess the key to that is you'd want to have some sort of formal legal binding agreement that the proceeds from the insurance policy would be used to buy the shares.
Okay, good, good. Um, Does it matter what industry my company is in, where I'm located, or what products I sell, when it comes to all the valuation concepts you've talked today, or are these universal concepts?
These are pretty much universal concepts. I mean, the metrics that you would apply for different industries may be different. I mean, something in a service industry may sell for 1 or 2 times revenue versus you really wouldn't apply that to something maybe in a manufacturing industry. But the overall concepts, particularly, the concepts of, the minority and lack of marketability discounts and the income approach and the types of things would not vary from industry to industry. These are kind of accepted universal practices.
Thank you. You mentioned earlier that the discounts you talked about today for marketability and control. if an owner were to just sell his company to a third party, those concepts would be ignored. Is that right?
Most likely, yeah, the control discount, certainly, if you're selling, particularly if you're selling 100%, if you're selling 100% of the company, then you're certainly not gonna, no one's gonna look for a control discount because the person who's gonna buy it's gonna have control. You may wind up, there may be a position where you would have a marketability discount. If you're still talking about securities, a non-publicly listed company that, you may wind up having a lack of marketability discount is not unheard of, not unreasonable, that situation, because the owner is still going to be stuck with something that he really can't convert to cash in 2 or 3 days. When they are factoring in their potential exit, they may be factoring in, okay, well, we're going to have this security. Think about if you're a business owner or non-business owner, and you've got $10 million to invest, say, I could put it in this company and buy it. And then 2 or 3 years from now, if I want to get out, I'm going to have to wait 6 months or a year or longer to get it back. Or I can just take it, invest it in Apple, and I can get my cash out in 3 days if I decide to change my mind. So a lack of marketability discount would not be inappropriate or unheard of. It certainly, I don't think would be as large as we might apply for an IRS situation.
Got it. So hypothetical owner is in his 60s, wants to get out, and he has children in the business, and he wants to consider gifting to them, or he doesn't have children, he wants to sell to the third party, and he wants to do a valuation. Is the whole process pretty much the same, except if he's selling the whole thing, he might not have the discounts for the control and maybe for marketability?
It's similar, although, like I say, when we're doing one for the IRS without cheating, we have an objective to try and minimize the amount of taxes paid. So if you're doing something for an outright sale to a third party, there would be some differences in approach and differences of coming up with a value, and you may not necessarily be as conservative in some of the assumptions that are driving the valuation.
Got it. Got it. You talked about the definition of control. Is the definition of control 50% or more, or are there other considerations? Can I
Well,
control the company if I don't own 50%?
yes, you can. I mean, for the most part, we're talking generally over 50%, but no, that's not the entire. There can be situations where there are minority shareholders who, for whatever reason, because if they have super voting rights or for just how the entity is structured, can own less than 50% of the company, but still wind up being the controlling shareholder. Again, that comes down to the specific facts and of the circumstances of the individual company.
And the appraiser would take all of that into consideration.
Yes.
Got it. Got it. I mentioned at the beginning that most of the things that you talked about today have been there for decades and decades. But one of the things that's in there that might change with the election would be the lifetime exclusion. It's now currently at 13.6 million, but after 2025, it could drop back to the 7 million that it was in, whenever the last tax act went through. Do you see the impact of next week's election having anything to do with whether that 7 million, we go back to the 7 million, or we stay at the 13.6?
Yeah, I mean, definitely. It's set to automatically revert back to the lower dollar value unless Congress acts to extend the bonus exemption. And certainly depending upon which house and which party controls the House and Senate and who's in the White House could have an impact on whether or not that expires and reverts back to the lower level or whether they extend it or make it permanent. So yes, it's 50-50, you pick them as close as the election is,
Got it. Got it. I kind of thought you might answer it that way. There's one more question, and that's back to this tax affecting or not tax affecting. If I have it right, the IRS doesn't like you to tax affect because it drives down the value of the business and they get paid less taxes. Is that right?
That's true.
So, but the appraisers will tax affect, generally speaking. Is that correct?
The appraisers, I think there is agreement among valuation professionals that it is more appropriate to tax effects earnings. It's just that the IRS's position is different. They succeeded 20-something years ago when Gross v. Commissioner,
Mhm.
but since then, there have been other cases in which they have not succeeded. And I think it comes down to that, you know, from the IRS's perspective, Gross versus Commissioner settled the issue. And courts have looked at it since like, well, not necessarily. We said it was okay not to tax affect in this particular instance, but that wasn't a blanket. It's never okay to tax affect the earnings. There may be situations for whatever reason, the particular nuances of the company that say that, well, tax affecting really is appropriate here. So it's still a question. It's still unresolved. But I would just say that the IRS's position is certainly, nope, don't do it. Um,
So if I hear you right, the IRS is pretty clear about their position, not tax affecting the valuation, but that there have been some chinks in the armor with some court cases where the taxpayer won by going with the lower valuation, considering the taxes owed, right?
Correct.
So when you did your example in the slides where there was a $10 million difference, you in the follow-up of that example, you gifted the lower valuation to the three kids.
Yes.
That's still an appropriate thing to do, even though the IRS would disagree or might
It's
disagree.
I guess it depends on who you talk. I don't think it's inappropriate.
Okay,
It's just the thing I think you need to be aware of the
be
fact that
aware
when
of
you're
it.
doing that, the IRS may challenge you on that. That may come down to a discussion between, if you're doing something for gift and estate tax purposes, between the taxpayer and the valuation professional to say that, hey, if we do this, there's a possibility the IRS may challenge it.
Got
They're
it.
not always successful.
Got it. But
Recently,
it's
they
worth,
haven't
but
been
it might be
successful.
worth trying.
Might be, you
Yeah.
know.
Let me just see if there's anything else here. I don't see any other questions. I think we'll conclude a little bit early and give people back a few minutes of their day. We want to thank you here at Stowe and Deegan for attending our webinar today. And I want to thank John in particular for the great presentation he made. And please, if look for the survey that you'll receive shortly. If you could please take a couple of minutes and fill that out, that helps us immensely as we prepare future webinars. I can tell you that our next scheduled webinar is on Tuesday, November 18th, and our tax colleagues, Prasanna and Mary, will be presenting. At least that's what's scheduled right now. It's a post-election landscape of the tax world. Hopefully we'll know who won the elections by November 18th. So that'll be our next one. So please look for the next case. I guess it's November 19th. I think I misspoke. Tuesday. So look for that. You should be getting emails from us at Stowe and Deegan soon about that. And please sign up for that.